Hi, everyone, and welcome to Lecture 1 on support and resistance of Module 1, which is going to be focusing on the fundamentals and the very basics of technical analysis, which are required for, in my opinion, any successful trader. You might not necessarily rely on the same tools that I rely on, but it's important to understand a lot of these concepts because at the end of the day, many other traders are looking at these similar concepts, and although that's a different form of analysis, a lot of psychological levels of support and resistance, a lot of the same levels are seen by a lot of the same people, meaning that it turns a little bit psychological in the sense that the masses are going to be looking at those similar levels and hopefully putting in bids or asks at those levels. So a little bit of interplay between technical analysis and psychology, or more psychology, I guess, thinking amongst the bigger market, what are other people in the market doing as well, because if you put your one bid in somewhere and there's a lot more supply in that time, then your trade doesn't matter. You want to be always thinking like the bigger fish, the bigger whales, the bigger accounts. So lecture 1 is going to be focusing on the very basic concept of support and resistance, and we're going to start even more basic than that. We're going to start by looking at and asking, what is the price of a good? Bitcoin 57,000, Ethereum 2,000, 1,443, whatever. What goes into determining that price? So, without going into an elaborate economics explanation, we know that the part or the value of this coin that we're most concerned with is going to be its the amount of supply of that coin and the amount of demand for that coin. So that's the very basics. Is for technical analysis, you're very focused and you're watching changes in demand and supply. So essentially, how does that play into price movement? So if you have a good and the demand for that good is increasing, then the value of that good is going to be going up because more people will be willing to pay a higher price for that good because the demand is so high. And the opposite is true. If supply is greater than demand, then you're going to see not more people looking to sell their good, but not as many people trying to buy their good. Therefore, people are going to be willing to drop the price to try and sell their good, or depreciation. So that's where the price drops. So now, why is that important to technical analysis? Well, the most basic component, or the most basic visualization that technical analysis provides, is a historical account of price action. No matter what chart you're looking at, the 1 hour, the 15-minute, the 4 hour, the 12 hour, the daily, the weekly, all these different time frames are just giving you a historical account of price action. What did price action do last week? What did it do in the last 15 minutes? What did it do 4 hours ago? So you're simply analyzing history in hopes of trying to predict the future. That's what technical analysis is. And you're trying to find patterns that have the highest probability of success in order to bet on them to try and make money. See, that is all technical analysis is. Anyway, in technical analysis, since it is a historical account, you see these points of inflection relatively often. We're going to be going into a theory called Elliott wave theory a little bit next in the next lecture, but I'm going to call your attention to this picture over here on the right side of the slide. Treat this black line as just the value of a price, right? So the price is going up here, the price is going down, up, down, up, down. This impulsive legs and corrective waves have to do more so with Elliott wave theory. We'll be talking about that in the next lecture, but these are the points of inflection that I'm talking about, because here you can see there was more demand than there was supply. All of a sudden, when we got to the top of wave 1, there's a point of inflection. All of a sudden in the market, there's more supply than demand, so the price is dropping. Right, another point of inflection here. Same thing with all these numbers 3 and 4 and 5, and that's why Elliott wave theory is based off of those points of inflection actually. Anyway, the areas that are going to be most important are going to be around the swing highs and swing lows, because that is before we see wave 3 happening, these are the only two levels that we know. And although this is identified as a resistance, and you would hope that price action rejects off of that, it can also be used as a confirmation of having upside continuation. We'll talk about that in a little bit when we get into the charts. All I wanted to say is Technical analysis simply is a historical account of price action, and thus you can visualize a lot of these points of inflection, or AKA, you know, zones of supply if it's acting as a resistance, or demand if it's acting as a support. Right. So exactly, these inflection points are used to identify areas of support and resistance, as we just talked about, and they're also known as supply and demand zones. You'll see a lot of people refer to them simply as support and resistances, but at the end of the day, they are liquidity zones or areas of supply and demand. In order to actually chart these, the most successful way, but also the way that requires the most experience, is manually, simply looking mostly at candlesticks and points, of swing highs or swing lows, points of inflection, combining that with candlestick knowledge and drawing out a general box or band which you believe is going to be a support or a resistance. However, this takes a while. You need some experience in the market to kind of find tops that are a little bit more significant than others. But this, if you practice it, it will come with time. Even if you go back into historical data, like I'll show you a very good tool to practice these skills here in a second when we go into the charts. But in the beginning, there's also an indicator called VPVR. I think it's not available with the free version of TradingView, but I think it is with the basic subscriptions. What the VPVR indicator does is a little bit different. It's not exactly mapping zones of support and resistance. It's essentially mapping zones or visualizing zones of volume. It's called a volume profile. In a sense, it's showing you the areas of most activity, or where the most transactions, where the most volume has been put in or out of the market. So although it might not be visualizing exactly an area of supply or the best area of supply or demand, it is visualizing a very used level, and therefore there's a lot of confluence and there's a lot of activity, and places where there's a lot of activity tend to be a good point as a supply or resistance. Slightly different definition, slightly different way of identifying it. The best way is to use both of them, overlap the two concepts. But most successful traders are, manually drawing those zones, and that's in a sense how you can get edge in order to, be above the market and hopefully make more money than the rest of the market. But that kind of concludes the lecture portion of this video. Next, I will see you on a chart, and we'll break it down a little bit more. We'll go a little bit more interactive, and we'll do some live chart analysis to see how these areas of support and resistance are important and how they work in the market. So I'll see you in a second. Hi guys, and welcome to the second portion of lecture 1 or class 1. So we'll get right on into it, since we've covered most of the educational or most of the theory in the lecture or the classroom portion, I guess, of this class. So from the previous part, you can recall that these points of inflection were our main areas of interest, and were usually, signs of a supply zone or a demand zone if it's acting as a support, supply zone, resistance, demand zone, support. So before we get into real price action, these points of inflection are going to be of most interest, and that's what we said in the lecture portion as well. So, and I will be using these. I'll be using the box tool to draw bands in and around these points of inflection. And if you've seen my charts, that's exactly what these bands are meant to represent, are going to be areas of demand zones or supply zones if it's acting as a support or a resistance. So without getting too much into Elliott wave theory whilst trying to incorporate another concept, there's going to be periods of, there's going to be periods of impulsive wave action and corrective wave action. And that's, I think, what the slide said. And I told you not to really worry about it until the next class. But without getting into it too deep, essentially you can see that waves 1, 3, and 5 are in direction of the trend. So they are with trend. Whereas waves 2 and 4 are counter trend. They're against the trend. And essentially what waves 2 and 4 are, these counter trend waves, is going to be periods of consolidation where it's either going to be accumulatory in nature or distributive in nature. So if you have a consolidation period, price action is, generally trying to gain some kind of momentum, or to mature in an area before it's ready for that next leg up or leg down. So if a consolidation pattern is bullish, or, in this case, I shouldn't say bullish, I should say with trend. If a consolidation pattern forms a with trend pattern, so either a bullish and bearish, in this case, the trend is to the upside, which means a bullish pattern. So if this consolidation pattern, wave 1 to 2, forms either of these bullish patterns I'm about to show you guys, then that means that once this pattern breaks out, it's likely to continue with the trend, or in this case, a bullish move. Whereas if a consolidation pattern is distributive in nature, it is a counter trend sign. So it's a sign of reversal, essentially, that, maybe we only got to wave 1, but in this consolidation period, we have signs of distribution. And if there's signs of distribution, then that is going to be counter trend. It's going to be a counter trend bias, and in this case it would be bearish, so we would expect a little bit of a reversal or a drop down. Identifying accumulation or distribution patterns is a little bit more advanced of a concept and will probably be covered in module 2 or 3. However, most of the time these patterns are pretty well representative of either being bullish or bearish. So therefore, if you are in an uptrend, if the pattern is bullish, then the chances are it's an accumulation pattern. Sometimes there is a chance that a bullish pattern will form, but it will break bearish. It'll break against what it's trying to show. And that's where module 2 or level 2 of analysis comes into account, because you can kind of get more edge by sussing out or figuring out which of these accumulation or consolidation patterns are going to break in the direction of the trend or against the trend. Okay, so that was long. I'm sorry if that was confusing. I can also break it down. But these patterns that I'm talking about, so bullish, and we'll also go into the theory behind these patterns a little bit, just in hopes of giving a little bit of reason to this madness. So this is going to be called an ascending triangle. And then before I explain it, the next one is going to be a descending wedge. I always get a little confused when I'm drawing these wedges. So we'll get to the wedge here in a second. First, let's explain the theory behind these triangles. So the triangles are going to be the most tradable pattern. These are also tend to be relatively common, but they are generally the most reliable in cryptocurrency. So a lot of people trade these. There's usually a lot of confluence. But similarly, how we have here an ascending triangle, the bearish version of that is a descending triangle. And similarly here, it's the opposite. It's going to be an ascending wedge. Okay, and then in between these, there's going to be another triangle. We won't exactly talk about it too much, just because it's an indecisive candle, so it's neither bearish nor bullish. It could really be going either direction, but it's called a symmetrical triangle. So if the top and the bottom resistance band look pretty much the same, not really sloping in a downward direction or an upward direction, relatively flat, symmetric triangle, it has no bias. It can go either way depending which way it breaks out and confirms on. But we won't be covering that. And also, if you're interested, there's a lot more patterns. I'm only going to be, talking about these 4. However, if you are interested in learning about more patterns, I have linked some resources in the videos file. So make sure to go there and check out. It should be pretty self-explanatory. It should be labeled patterns or something like that, cryptocurrency patterns. Okay, so let's talk about why these work and how they work. So going back to the concepts of supply and resistance, right? So if during this wave 1 to 2, when price action is generally moving sideways, it's going down, but it's not really breaking down below this original level where it started, it's consolidating, right? So if over this consolidation period we notice that the level of resistance is staying relatively constant, but the level of support is gradually rising, what does that mean? That means demand is staying consistent. People are all selling at the same price. However, people are willing to buy it at a higher price, meaning that demand is increasing. Eventually, either close to the apex of this triangle, we'll talk a little bit about wave counting and Elliott wave theory. So that, is another way to kind of gain a little bit more of a timing edge to when one of these patterns might break. But essentially, This is a bullish pattern because demand is increasing more than supply, so the breakout is to the top side. So you might be confused as to why a descending wedge is considered bullish, though, in the sense that price action is contracting to the downside. Well, without getting into it too much, since both trend lines are sloping, that means there's going to be dynamic change, right? So there's going to be changes in both supply and resistance, in support and demand. Sorry. No, demand and supply. It gets really confusing. Demand and supply. So in this case, we can see that supply was not changing, whereas demand was increasing. So here we can see that supply is actually increasing by a greater margin than demand, right? Or decreasing, sorry. Supply is increasing by a bigger margin than demand is. But essentially what ends up happening here is the demand overpowers the supply and there's supply exhaustion. So this essentially at the apex becomes null, and the bulls are able to overcome this huge pressure of this time of compression, and the bulls win and there's a breakout to the top side. Opposite is true for the descending triangle. In this case, supply is able to increase, more and more and more, whereas demand is staying the same, and for the same reasons, supply is able to overpower demand and the break is to the downside. Similar kind of reasoning here. Demand is, initially increasing by a lot more than supply, but supply is, since it's increasing less, I guess you can think of, it's running up less steep of a hill, so it gets tired less. And then this is running up a steeper hill, so it gets tired more, and eventually you get exhaustion, and in this case, bearish reversal. In terms of targets, strictly speaking, the target is going to be for the triangles, it's the measurement of the base put on top of where it broke out. Same is true for the descending triangle, except it's not the same measurement. This is the measure to the downside. Whereas with these wedges, it's going to be simply to the bottom or the top of where it started. So in this case, it'd be up to here from where it broke out, whereas over here, it's going to be to the bottom of where that pattern started. But I think that's essentially it for what I wanted to do before we actually got into some price action. And I have to remember to use VPVR because I forgot to do this last time I recorded this video. So I'm just going to add it right now to the chart. Okay, so what we're going to do is we're going to look at it first, actually. I just need to change some things. Okay, so what I just did was I changed the row size in order to increase the amount of rows, and this just gives you a higher, more detail to what's going on, because, if it's at 50, you have very rectangular bars, whereas if you turn it up to like 1,000, you have more of a detailed visualization of these mountains and valleys. So I personally do not use VPVR much now. I used to rely on VPVR quite a bit back when I was beginning. So I definitely recommend it if you're a beginner. However, I would also start not using it as much. Obviously, have it in your chart if you need it, maybe hide it. Try and, draw these out manually, but always double check with the VPVR. Also to gain a sense of confluence or which of these levels might be, more important than other ones. And you can emphasize those with, a darker color or, some color coding system, whatever works for you, So first we're going to plot out our, levels of support and resistance manually, and then we'll come back at the end and take a look at how they match up to VPVR. Also, in terms of practicing, one of the most underrated tools on TradingView is the replay tool, which is at the top here. Essentially, what you can do is rewind price action and then, watch it as, pseudo live. You're going to watch a historical account of it unfold and, practice as price action is kind of unfolding, because if you're just, drawing levels from here, it's relatively clear looking, retrospectively now where the next tops were. So, that obviously this band of resistance was a little bit thicker, whatever. That's cheating a little bit because you can already see what's happening in the future. The best way is to really, rewind to that time period and watch it, unfold before your eyes. Okay, so let's get right on into it. I'm going to take a little drink. My throat's getting a little dry, sorry. And let's get started. So for this class and this lecture, we're specifically focusing on those patterns that we just described. But more importantly, we're looking at supply and resistance. And the way that you identify a pattern is by those changes in demand or supply. Supply, aka resistance, demand, aka support. Get comfortable with using those terms interchangeably, but what is the trend between the two of them? And that's something that we'll talk about in the next video as well, is establishing trend. Also, something I should have mentioned in the introductory video, how to kind of identify and spot a trend. But let's not get into that. Let's get right into this. So after this initial pump, we haven't really put in a swing high yet, but you can see that, we put in a relatively bearish candle. However, not enough, not really competing with this level. So we can actually, plot kind of our first demand zone right off the bat. We can see that this area seemed to be acting as, resistance, because one of the last classes goes into candlesticks. I didn't want to cover it in the beginning, although, it is technically a basic, but you need to be able to spot these other things before you can use candlesticks to refine fundamental concepts. But essentially what's happening is candle body opens and closes are the most, I want to say accurate, or the accurate, or not hardcore. I don't want to say hardcore, but the most accurate representation of price action, because that's actually a price level that, historically price action either opened or closed at. Whereas a wick tells more about the story of that candlestick or that time period. So in this case, in 4 hours, what happened? The candlestick gives you a little bit more history about what happened in that time period, whereas open and close is more of a definitive fact. This is where price opened and this is where price closed. So that's why I say, if it's a fact, it carries more weight. If it's a wick, it's a story, so it's important. However, should still be considered, but not the most reliable or the most important part in mapping certain things. Important in telling what the future might hold in terms of price action, but not exactly in terms of drawing. So you want to try and get as much confluence in these bands. So the more wicks and the more candle body closes you can get within the same zone, the best, because what that is confluence. You have overlapping data, or overlapping not bias, but overlapping evidence. There we go. Evidence showing a certain zone. Okay, sorry, that was a long ass ramble, but this acted like a area as a pivot point, before we were able to come back up. And we can see that in these similar levels, we actually managed to come, and we bounced off of it here before further upside continuation. So I'm literally just drawing a box from this candle open / close to this candle open and close. And we can take it back a little bit further, actually, to see how that played out and how that was useful. Let's go back to here. So right off the bat, we can see that, okay, we can't really tell too much. However, let's draw in that band that we were talking about. Originally, I'm not going to take these are huge long wicks. So max, I'll go up to this wick over here, because obviously after touching that level, we got a huge reaction. We got a very bearish reaction. So important level to keep in mind. So let's see what happens as we move forward. We can see we're testing, that resistance. Okay, flip it. Now it's acting as support. It's acting as support. We haven't broken through it. And right there, you can see a resistance flipped support. And that is one of the qualifications, or one of the things off of a checklist for a breakout. So in a sense, this was tradable. You could have, continued, traded a continuation here after this resistance broke support. But now we're waiting for our next kind of pivot point to see, what level of interest. Where is price action going to hit a supply zone? Where is it going to hit resistance before trying to accumulate and break through again? So, okay, so we can see right off the bat, after hitting this level, this is our absolute top, we got a violent downward reaction. So another point of inflection, or another important zone to keep mind of. Once again, we don't have much data, so we can't do too much in terms of plotting this. However, once again, I'm going to take these candle body opens and closes into account, and I'm going to use that top side of the wick again, because that's the only data we really have so far. And you can refine these as you go. So you can see it's acting as resistance again. What's going to happen? We're getting a little bit of a drift in the middle. Once again, you could map this as another support if you wanted to go down on the lower time frames. This would probably appear as a support, but once again, that's something for a lower time frame. But you can see, once again, this resistance now flips support, and we're getting continuation from there. So let's see where this goes. Okay, so we came down. Once again, you can see it's acting as support. Oh, what happened? Actually, did not hold for our next period of consolidation, or our next period of continuation. So we got a resistance off of there. So now we can refine this box, because now we have more data, and we can say that, oh, okay, this seems like an indecisive area. This is an area where supply is likely to increase, because we recently had that over here, and now happen again slightly higher. So good levels to keep track of. And I'm going to expand this as we go. Okay, so now we broke through our initial identified support, but we put in another pivot point. And you can see we do have some confluence with the bottom side of the range here right after we came to pump. So once again, we see two areas of confluence. That's an important level. Let's draw that out. And it's another point of inflection. It's going to be an area of stronger demand. So what I'm going to start doing actually is extending these boxes so we can see how they're useful in the future without me having to keep on extending them. So you can see we have some confluence over here. The most important thing to focus on is more recent data. So obviously these levels are more recent, thus more important than these levels, but it's nice to see that overlap, that confluence. So now we can change the color of this because it's been broken through, so it's a little bit less significant. It's still important because it is a key level. However, it carries less weight as we've established a wider range. And that's something we'll talk about hopefully in the next video as well, is trading these ranges and kind of identifying periods of consolidation versus trend. But we can see that in terms of support, it hasn't changed. It's about the same level. Let me extend this box just so we can see how, because now we're testing the top side of the range, right? That's where our original supply zone was. So this is time where you might expect a little bit of a rejection, or are we going to break through, retest it before continuation? So you can see we tested it, acted as pretty major resistance. So look at that, we got a perfect test of our supply zone, acted as resistance, fell all the way down to that intermediate zone, where that zone now acted as strong support, and we're probably going to go up and test that zone again. So let's keep watching what happens. Right, going right back into that top side supply zone or resistance zone, and I'm going to extend this in case we need it. Price action is continuing. Okay, so what are we noticing here, right? So now we have this swing low, this point of inflection. We have another inflection point slightly higher than this, and we have another point even higher than this. And this is something that we'll discuss in the candlestick lecture. There are certain candlesticks that are more indicative of a reversal or of being a top or a bottom. And that's how you confirm some of these swing lows or swing bottoms, right? But all of a sudden we're seeing, okay, resistance isn't really increasing because this band has now acted as resistance 1, 2, 3, 4 times, whereas this band of support has only been tested once, and ever since then support or demand has been increasing. So this is a time point where you observe this dynamic shift in supply and demand, in the sense that demand is increasing. So you can draw in a trend line here. I'm going to turn the magnet off, but essentially you should be drawing in the top of that triangle as well. I like to use these bands because a line is not going to be as representative as this band of resistance, but it might look something like that. So let's see what happens here. Is we've gotten a pretty mature ascending triangle. Oh, we're breaking out. Look at that. We came to the apex of this ascending triangle, and as predicted, a bullish accumulation pattern. We're getting a breakout. So, not much of a breakout. Swung a little bit higher, now testing band, okay, but acting as support. So now we see where this, relatively strong resistance that was tested a couple times has flipped into, a relatively, I don't know, I can't talk, in the future here, but it looks like it's been tested successfully as support here because we've put in a swing low now. So this is where demand is now greater than supply again. But maybe we'll get a dump. Oh, yep, we do get a dump. So an unsuccessful test. Once again, that mid-channel, level becoming significant. What do we notice though? So although this worked for a small, breakout, still technically tradable if you had the correct RR, we notice another macro higher low because this is our, overall our lowest low. And now we have another higher low, although, not as high as this one, but in general, still a higher low. So I'm going to connect those two lows to keep those in mind. Whereas, with price action, we can draw off of the macro swing highs and the macro swing lows now. So now, we're forming a little bit of an ascending wedge. Let's see, how this continues to play out. So, still, I should have said, you could also technically draw this as a band of resistance here. We did that in the beginning, so we should stay relatively consistent. But, not that much wick activity, so, a very thin band, therefore, probably not that strong. But acting as resistance, now we're playing between these two levels. And this is where styles of trading comes into play too. There's some people that scalp, they only intraday swing trade between these smaller levels. There's people that trade bigger levels, and there's other people. There's a lot of different strategies, and it's all about finding what works for you best. But here we can see we did put in another macro higher low, so therefore this trend line is still being supported. So the overall trend of what's going on is still forming this ascending wedge, which is a little bit concerning. But you can see these two zones of support and resistance have been pretty good. We've gotten 1, 2, 3 tests of that top side band, and equally as many with this bottom side range here. But actually, what are we seeing in more recent price action, right? So I said we had 3 tops at around the same level, right? So although there's a greater ascending wedge forming, it doesn't have confluence with more than 2 points. However, this diagonal here now has confluence between 3 points. And what do we have here? 3 bottoms to accompany those 3 tops. So what is this forming? An ascending triangle. So therefore, it's all about finding the higher probability setups. So although we had a bearish ascending wedge here, the top side or the resistance band only had 2 levels of confluence because it was only tested twice. Whereas this line has now been testing 3 times, meaning it has more confluence and it has more maturity. So it's more of an important level than that other level. Same thing here. With our ascending triangle here, the bottom side resistance of that, bottom side support of that ascending wedge, we had only 2 tests. We only had this bottom and this bottom. Here we have 3. So more confluence, higher probability of happening. So let's see what happens here. We have a little bit of an ascending triangle. Okay, so it's respected. It's okay. We didn't get a double closure below, so that's usually a good sign. Pretty big area of resistance. Oh, but here we go. Little bit of a breakout. Let's see if it's a fake out. Nope, doesn't look like a fake out. Looks like we're getting continuation without a retest, meaning that's probably, that's a pretty healthy breakout. So let's see what happens when it continues. Let's continue watching it. As we're going, we can also, start kind of mapping bands of support and resistance. But these are going to be very thin. These are probably going to be more important to you on the lower time frames, but same kind of idea that we had over here, maybe not even accounting for that top wick, and this is where experience and kind of edge comes in, is how many of these wicks do you actually account for, and that'll come with time when you find a system that works for you. So now, our new kind of established range. See what happens. That's acting as support now. Nope, wasn't good enough. Came back down to the bottom side of the range. Oh, okay, we're breaking back down towards those original levels. So right around here, right away, we can see that, we have a bigger, more macro low, more important because it's lower than this. So I'm going to actually just move this box down here. We have a little bit of confluence between price action here. So I'm going to, call it a little bit smaller. That's a pretty wide box though, but it realistically could probably come down to around here. So let's call it a little bit wider than we should. It's always better to be a little bit more safe than sorry, but here you can see we got a breakout of this resistance, acted as support. We continued up, and we should have marked off this local inflection point as well before. I'm only using these wicks right now. I'm not looking at what's happening technically right now in price action, but you can see it's been acting as resistance. This is a pretty bearish candle over here, so this might have been some bearish bias, but it looks like we might get bulls might burn through that. And this is where things get a little bit annoying, is you're going to get a lot of this messy sideways action where it's a mess of higher highs but lower lows. So it's not very nice to draw a trend line through. So if it's not very obvious, the longer you wait, probably the little bit more mature it's going to become. So right away we got another key level right around here, acting as resistance off of that inflection point. And once you get a grid like this on the lower time frames, where you get a little bit more high-paced price action, that's where a lot of people make most of their money, and that's their bread and butter. Oh, so what do we notice here? Right? So now we have three tops. We have three tops in ascending order, but contracting price action. So what does that mean? Let's draw a trend line to it. So in this case, I'm going to use an extended one just because I'm being a little bit lazy and I don't want to, draw it all the way through. However, okay, we got fair. Now, what's happening to support or supply? We see that it is also increasing. Maybe not. Maybe we can't draw any conclusions to supply just yet. I mean, to support, just because, if we drew it to the next swing low, technically this has been a breakdown of an ascending wedge. So bearish. So, technically you could have played this. This is probably what some people were playing where, the price action dumped here. So you can always be keeping track of these patterns, but I'm not going to draw it in just yet because I'm more interested in something that has a little bit more maturity to it. Oh, so here we go. Our next major swing low. But you can see this area that we drew in was perfectly respected after a clear rejection, this long wick. We can see that the zone was perfectly retested before a little bit of upside pressure. But now we also have another major swing low, so which is a little bit more palatable or a little bit more drawable, I guess, just because we haven't crossed it yet. It hasn't been broken just yet. Okay, so let's see how these levels continue to be respected. Obviously, resistance acted as support here. We're getting a breakout. This is obviously also a little bit of a love key level here that acted as support. But we can see we're moving towards the top side of that, resistance. Let's draw this one in really tight right here, just because it is technically a inflection point. So, oh wow, look at that, all the way from the top side of our trend line to the bottom. So that's a pretty good, that's a pretty good indication that these trend lines, it has been tested 3 times now. A trend line becomes a trend line after it has 3 points of confluence. We have 1, 2, 3 points of confluence, 1, 2, 3 points of confluence. This is relatively mature. This is a pattern that could technically play out. So let's see what happens. Oh, we get a big dump. Wow, look at that. A huge dump. A huge dump. Wow, out of our ascending wedge. And let's see how that played in terms of a measured move. So there's a couple of different ways to kind of, set targets. The best way is going to be with Fibonacci, but from the most simplistic measured move, we can actually see, look at that. Wow, the wick off of the first dump was almost to the exact level of the measured move. So, that's relatively a good gauge. I wouldn't say it's always perfect. It's a good gauge to get an idea of how far a move might go. But once again, look at that perfect, test and rejection off of our supply zone or area of support. So that's why keeping these historic levels in check and around is quite important. And I think here, just continue to see how important and like how respected these levels are. Once again, acted as support here, resistance here, acting as resistance here, acted as support here, support, once again, resistance, support. Once again, on the lower time frames, these are much more drawn out moves. We're on the 4-hour time frame now. So once again, back into that area of support, does act as support, it bounces off. Here, I think we're going to see a little bit of a different formation form that I haven't covered, an inverse head and shoulders, this being one shoulder, this is the head, and now we're dropping to form the other shoulder. Not quite a perfect rejection or, bounce off of this support, but, still looking relatively valid, mighty rejection off of this zone, perfect test right here. And, perfect test off of that support zone. Getting a lot of sideways action here, not very nice, not really matching any trends. You can't really draw anything, but that head and shoulders with the neckline around this level. We're going to bounce up. We can speed this up a little bit in the interest of time, but the most important thing here is to keep an eye on how respected these levels are and why they're so important. Many traders only trade price action context and essentially only trade these levels. And then we're getting a little bit of a breakout, getting a retest now. And there we are at current price action. So that's it. We have a little bit of different of a pattern here. We have a flag here that we broke out of, but that's a pattern that you can look into on your own. So we're going to compare this with VPVR at the end. So let's throw up VPVR. Let's get out of this. So what can we see? So we can see that our band of resistance, you can see why now this is where you get a little bit of contrast between the manual method and the indicator method. You can see we did cover that point of control, and that's where we ended up getting a perfect, test off of. However, we were also accounted for a little bit of this valley that, VPVR wouldn't exactly show you. Same thing here, the bottom mountain of this one, also, an area of support or resistance right around this mound. So you see, generally it matches up pretty well, but it's usually a little bit shifted. It's a little bit different. So that small amount of edge can give you a big advantage in the market if you know how to do it manually. But that essentially does it for the first lecture video and the first kind of, let me draw this in at the end actually right here. So we're staying consistent. But that essentially brings it to the end of the first, application of class 1, lecture 1. So hopefully you found this helpful. If you have any questions, feel free to reach out in the VIP chat or anything like that. But this really is the number one fundamental that people should understand before looking into technical analysis and trading further. So practice, use the rewind tool, ask any questions, and I'll see you in the next one.